Hello, I'm Mark Dunne, and I'm the editor of Portfolio Institutional, a magazine that looks at the investment side of pension schemes, insurers, and charitable foundations. Welcome to what is the first of 3 discussions looking at index investing in fixed income. Now, this particular video will look at the modernisation of the bond market. Now, there are many factors to consider when building an investment portfolio, such as liquidity, diversification, and cost. Technological innovation and product developments have helped make this process easier through building portfolios more effectively in many markets. But has it made index investing in fixed income more efficient? To find out, we've put together quite an experienced panel. So let's start by meeting them. Natasha, could you just introduce yourself, please?
Hi, my name is Natasha Blackman. I work at BlackRock in the iShares fixed income product strategy team.
Thank you, Natasha. And Smadar.
Hi, everyone. I'm Smadar Shulman. I'm heading up indices product management at IHS Markit, and specifically also focusing on our iBox fixed income cash bond indices.
Thank you very much for that. Now, Natasha, could we start with you? What challenges do investors face when navigating the fixed income markets?
Sure. So investors face a number of challenges when navigating fixed income markets, including on the macro side with portfolio construction and liquidity. Persistently low yields have presented a significant challenge for investors, who face increasing pressure to deliver returns while maintaining diversification. And the COVID-19 crisis last year further highlighted potential liquidity challenges in fixed income markets, really during a period of exceptional volatility. The evolving regulatory landscape post-MiFID II has also led to a push for transparency, as well as cost efficiency, which has been a challenge for investors really looking to navigate traditionally opaque and illiquid bond markets.
Thank you, Natasha. You covered quite a lot there, but Smadar, do you have anything to add to the question on what sort of challenges investors are facing in this market?
Yeah, definitely. So following on from Natasha, portfolio flexibility can be more of a challenge in fixed income. 2020 was a stress test for all investors' portfolios. And as market volatility soared in the March 2020, many investors experienced challenges with their fixed income allocations, which were not able to offer the liquidity, price discovery, and flexibility they needed to be able to de-risk as markets were selling off. So investors have been taking a holistic approach to portfolio construction, increasingly focusing on investment outcomes and using ETFs and indexing to drive portfolio resilience and diversification.
Thank you, Smadar. And Natasha, what role do you see fixed income ETFs playing for bond investors?
So as the structure of the European bond market continues to evolve in response to changes in regulation, technological advances, and shifting investor behavior, the influence of UCITS fixed income ETFs within that bond market ecosystem is growing. And with the challenges that they face in investing in fixed income markets, we've seen investors make use of broader toolkits when managing their portfolios, using a combination of funded and unfunded instruments to manage their risk. ETFs have become part of this toolkit as they offer investors certainty of execution, immediacy, as well as price discovery, even in fast-moving markets. And we saw this during the COVID-19 sell-off. From late February through late March 2020, iShares fixed income UCITS ETFs traded 17.5 billion in notional on average per week, which is more than twice what they traded in 2019, which saw an average of 7.8 billion. So while we've previously seen increased trading during fast-moving markets, what we saw in March was really unprecedented in just how much investors were using the fixed income ETFs to access and transfer risk. With the development of fixed income ETF options, as well as the repo and unit lending markets for ETFs, investors also increasingly have the ability to trade ETFs from both the long and the short side, and that has further helped to enhance liquidity. As well as liquidity, the diversification and transparency offered by ETFs have helped them to really become central to valuation, portfolio construction, as well as risk management for institutional investors.
Thank you, Natasha. Now, Smadar, I mean, how can ETFs improve portfolio resilience during a market downturn, such as we saw last year in 2020 following COVID?
Sure. So one key challenge for fixed income markets experienced last year in the March market dislocation was the pricing of the bonds underlying, various market instruments. And in terms of transparency, indexing through ETFs offered the price discovery that was needed. Let me read out a quote from the Bank of England interim financial stability report in May 2020 on the price of bonds, which I think highlights this. And I quote, appear to have provided information about future changes in underlying asset markets, offering evidence that they incorporated new information more rapidly than the net asset values, or NAV, of assets held with their and equivalent funds. So as an index provider, we also saw a very notable increase in the trading of unfunded index products to manage market disruption, so similar to ETFs. And on the pure credit risk side, CDX and iTraxx indices, including swaptions, saw around 30 trillion in notional traded in 2020, which is far higher than the previous year, for example, around 2025. And at the height of the crisis, the volumes were over 50% higher year on year. So that can be partly attributed to their ability to withstand large trading sizes. Similarly, volumes on the iBoxx standardized total return swaps, or TRS, were also high during this period. From a hedging perspective, we saw that these tools being used to manage exposure into cash bonds or into different mix of high yield, investment grade, and other asset classes without altering the underlying portfolios too much. The growth and depth of liquidity in tradable credit index products continues to benefit the developing fixed income ecosystem. And additionally, ETFs remain robust, and more broadly, the portfolio ecosystem has evolved. So portfolio trading is now heavily linked to the create and redeem process of ETFs. All these bring standardization, price transparency, and trade efficiency to an otherwise often opaque, as was mentioned earlier, opaque and fragmented fixed income market. In 2020, we saw how in times of stress, these instruments performed as intended, provided continuous liquid access to key exposures, which allowed investment managers to manage their exposures in an efficient manner.
Thank you very much for that. And actually, sticking with Smadar on the final questions now, where are you seeing innovation within indices?
So there's a lot of development in the environmental, social, and governance, or ESG space, and in variation in how it is implemented and the available ESG product suites, whether it's through basic screening of companies engaged in controversial practices, applying minimum standards based on ESG ratings or scores, or in combination, sometimes that's referred to as best in class, applying weight tilts based on ESG scoring, for example, or even optimization to keep certain, sector risk profiles. We also see thematic products such as in climate or carbon related, as well as green and social sustainability bonds. And in that regard, we've launched several products that meet the varying needs of clients. For example, the iBoxx MSCI ESG Ultra Short, kind of a best in class range, as well as the IHS Markit Global Carbon Index tracking the price of carbon credits, and iBoxx Global Green and Social Sustainability Bonds Index. So when we think about sustainable indices, one of the considerations for fixed income specifically is managing the ESG data itself. ESG data is often based on listed equity, so equity-like data, whereas bonds can be issued under different entities along the corporate hierarchy, including private entities. And having a robust framework in place that maps and handles exceptions is really crucial. And we've spent a lot of effort on this aspect to enable the handling exceptions, and that's really crucial. To be able to have adaptable integration of these ESG factors into our fixed income indices. Alongside the data considerations is the index design, of course. And investors are looking for a transparent, rules-based approach to sustainable investing. So designing products that are liquid and replicable, which fit the underlying market they are trying to track, is important. Something that we obviously do for non-ESG indices, but also important when incorporating ESG criteria. And investors are looking at different design features depending really on their objectives. So really, we see ESG is continuously evolving. And also with more data points being captured as company reporting evolves, this in turn will also shape continued product design across asset classes.
It's quite interesting there, because ESG, I mean, do speak to a lot of people in ESG in the bonds, but efficiently getting them into bonds is one of the biggest sort of question marks at the moment. So that's definitely where the market is moving. Natasha, final question to you. Where are you seeing innovation in the ETF landscape more broadly?
Sure. So away from sustainability, which obviously is a major area of innovation, another area that we're seeing is in the increased interest in options on ETFs in Europe. The launch of listed options on UCITS ETFs has increased the toolkit of existing ETF users, but also brought in a whole new group of market participants into the ETF ecosystem. From a market structure point of view, the impact of having the transparency into ETF turnover through Bloomberg, alongside the development of the securities lending or borrow market for fixed income ETFs, has meant that price makers have become comfortable and they can hedge their risk. Many different types of clients have shown interest in options. Similar to the underlying ETF market, that diversification of client type will really be important to its success. The obvious first adopters of the products were asset managers, kind of both multi-asset and fundamental fixed income portfolio managers. But we've also seen increased interest from pension funds, from insurance companies, hedge funds, and even some private banks. Two benefits which drive the interest are that first, the fact that they're listed and therefore centrally cleared, which makes them more efficient from a counterparty and collateral point of view. The second is that the underlyings are fixed income ETFs, which track broad indices. And therefore, the performance of that underlying asset is closer and hence a better proxy for cash markets than alternatives such as CDS index options. From pension funds specifically, we've seen interest from some who have historically used equity index options for yield enhancements through selling out of the money calls. And they're now looking at credit and EM debt ETF options and seeing the same utility in the fixed income market.
Natasha, Smadar, thank you very much for your time. That was quite a fascinating, insightful discussion. I'm sure that you've satisfied many people's curiosity there on how the evolution of ETFs and index investing in the bond markets. Thank you very much and goodbye.
Thank you. Pleasure.
Thank you.